This is ShadowQuant, Crypto Edition, brought to you by AresLabs.ai. Before we begin, please note, what you are about to hear is an AI agent panel. All analysis, voices, and production are generated by artificial intelligence. Nothing you hear constitutes financial advice. Always do your own research. Today is Monday, July 20, 2026, and this is the Tokyo session. Now, let's get into it. Bitcoin is hovering at $64,643, clinging to support, while the Fear and Greed Index plunges to 14, a level of extreme fear usually reserved for crashes. But here is the anomaly. Despite this retail panic, Bitcoin futures demand has collapsed to 2024 lows, stripping the market of leverage just as institutional players begin tokenizing trillions in assets. We are watching a market where the crowd is running for the exits, but the architects are pouring concrete foundations. Turning to our calendar, there is one major corporate event to monitor this week that could reshape exchange liquidity structures. On July 21st, PayPay, which owns 40% of Binance Japan, is filing for a Nasdaq IPO seeking up to $1.1 billion in valuation. This is a significant institutional entry point for Asian crypto capital. APEX, what does the timing suggest for the current market structure?
It suggests a potential liquidity injection right into a market starving for volume. With Bitcoin futures demand at 2024 lows, having a major Japanese fintech giant list publicly could redirect passive capital flows into spot markets rather than derivatives, effectively filling the void left by cautious institutional traders.
The broader snapshot shows total cryptocurrency market capitalization at $2.294 trillion, up 0.17% in 24 hours. Bitcoin dominance sits at 56.54%, while Ethereum holds 9.85%. Active cryptocurrencies stand at 17,669. The VIX is elevated at 18.77, indicating persistent equity volatility. Yet crypto appears to be carving out its own path. Let's break down the drivers. 3 headlines are moving the needle today. First, TD Securities describes NYSE tokenization as an institutional turning point, directly boosting infrastructure plays. Second, the U.S. Senate housing bill now includes a CBDC ban, providing regulatory clarity for decentralized systems. And third, Bitfinex is reviving tokenized bonds targeting crypto-native yield seekers. CIPHER, how are flows reacting to this institutional pivot?
We are seeing a clear bifurcation. The collapse in Bitcoin futures demand tells me speculative leverage is exiting, but the tokenization headlines are pulling capital into utility-heavy assets. We aren't seeing a broad rush back into Bitcoin spot. We are seeing targeted inflows into chains that facilitate this new institutional layer, specifically looking at links between traditional finance rails and crypto settlement.
But let's look at the risk side of that coin. While TD Securities and Bitfinex are building bridges, we have a 700% spike in Iranian crypto outflows following recent U.S.-Israeli strikes. That is not just flow, that is chaotic, sanction-evading volume. It introduces a regulatory overhang that makes institutional turning point claims fragile. If regulators crack down on these off-ramps, the very infrastructure being built could face scrutiny.
And yet, the retail crowd doesn't see the geopolitical nuance. They see red charts and negative headlines, pushing the Fear and Greed Index to 14. They are selling the structural growth because they are distracted by the noise. The disconnect between the 14-point fear score and the rising tenor in sentiment, up from 12, is where the opportunity lies. Let's dive into the primary driver, Bitcoin. It is trading at $64,643, up 0.56%, with a 24-hour high of $64,979 and a low of $63,743. Grid, you're tracking the technicals here. What is the structure telling us at this price level?
Bitcoin is exhibiting classic consolidation mechanics at the $64,643 mark. The key observation is the interaction between price and liquidity. Bitcoin futures demand has collapsed to 2024 lows. This means there is virtually no leverage buying power to push price higher, nor is there heavy short selling to crush it lower. It is a vacuum. The price is holding solely due to spot absorption. The critical technical level is the $64,000 psychological support. A break below exposes significant stop-loss clusters, but currently we are in a fragile equilibrium maintained by spot accumulation rather than leveraged conviction.
I need to push back on the idea that this is purely spot absorption. The collapse in futures demand is a signal of institutional caution, not just retail thinning. When open interest drops to these levels, it often precedes a directional move because the buffer is gone. We are seeing the same caution in the mining sector. Core Scientific turned lower after disappointing Q4 results. That is a fundamental stress signal for the network's hash rate security at this price point. It's not just a technical level holding, it's a battle for miner solvency.
Exactly. Grid treats the $64,000 level as a static floor, but with futures demand at 2024 lows, that floor is porous. If we lose that level, there is no leveraged capital to step in and catch the falling knife. We are left with unbuffered spot selling. Combine that with the 700% spike in Iranian outflows. That is a risk flag for sudden regulatory scrutiny on stablecoin flows. The probability distribution here is skewed heavily toward downside volatility if volume picks up.
There is a competing force at work here, SPECTER. You are focusing on the absence of leverage, but Grid overlooked the presence of structural bids. The fear and greed index is at 14, yet Bitcoin is still green at plus 0.56%. That decoupling suggests that while retail is fleeing, large-scale holders are accumulating quietly. The narrative isn't just about survival, it's about preparation. The tokenization trends from TD securities create a long-term demand curve that is completely disconnected from the short-term fear gauge.
Moving to the secondary driver, Avalanche. Avalanche is up 2.21% to $6.57, with a high of 6.63 and a low of 6.40. This is the top mover among major caps. Grid, is this a breakout or a dead cat bounce?
Technically, Avalanche is breaking short-term resistance. The move to $6.57 is accompanied by relative strength compared to the broader market. Unlike Bitcoin, which is consolidating in a vacuum, Avalanche is showing volume expansion consistent with a genuine rotation. The key level to watch is the retention above 6.50. If it holds, the path of least resistance is toward higher liquidity zones around 6.80. It is confirming a shift in capital preference from legacy infrastructure to high-performance layer 1s.
That rotation is fueled by the uncovered nature of Avalanche relative to the crowded Bitcoin trade. With Bitcoin futures demand low, capital is seeking yield and utility elsewhere. The tokenized bond initiatives mentioned earlier, combined with Avalanche's enterprise partnerships, are attracting a different type of flow, not speculative day traders, but yield-seeking institutional capital. This explains why Avalanche is up 2.21%, while softer assets like XLM are down 1.36%. The money is going to where the legal rails are being laid.
And sentiment supports this. Retail is scared of Bitcoin's stagnation, so they are chasing momentum in Avalanche. You see that in the fear and greed index hitting extremes. When people are terrified of the main store, they run to the side door. The fact that Avalanche is leading while Bitcoin lags indicates a risk-on rotation among those who remain in the game, masking the underlying weakness in the broader sentiment.
Be careful, Pulse. Momentum is not safety. Avalanche is up 2.21% precisely because it is smaller and easier to move than Bitcoin. In a market with such low futures demand, a slight increase in sell pressure on Avalanche could result in outsized downside percentage-wise. The 700% Iranian outflow spike creates a ripple effect. If global risk appetite sours due to geopolitical tensions, high-beta assets like Avalanche will fall faster than Bitcoin. It is a leverage play on risk sentiment itself.
Let's look at Chainlink. Chainlink is up 1.49% to $8.45, with a high of 8.50 and a low of 8.30. This move correlates with the institutional tokenization headlines. CIPHER, what is happening in the flows here?
Chainlink is acting as the primary beneficiary of the TD securities narrative. We are seeing inbound movement from exchanges associated with institutional custodians. The flow data suggests that entities are accumulating Chainlink for staking and Oracle services, anticipating increased activity on tokenized securities. This is distinct from speculative trading. It is operational accumulation. The link between the CBDC ban legislation and Chainlink's rise is direct. Legal clarity reduces counterparty risk, making Chainlink's cross-chain infrastructure more attractive to traditional finance players looking to enter blockchain.
From a technical standpoint, the rise to $8.45 breaks a minor downtrend line. The key support is now established at 8.40. If we hold this, the structure is bullish for a retest of the 8.60 area. The volume profile on this move is cleaner than what we saw in Bitcoin, suggesting fewer weak hands are present in the order book. It looks like a structural base formation rather than a fleeting spike.
The sentiment angle is crucial here. The public discourse around CBDC is highly polarized. By including a ban in the housing bill, the political narrative has shifted from if to when, and Chainlink is positioned as the antithesis of centralized control. Retail investors who feel alienated by government oversight are rotating into Chainlink as a hedge. This isn't just technical, it's ideological. The $8.45 price reflects a vote of confidence in decentralization by a segment of the market that feels ignored by traditional banking.
Or it's a vulnerability. If the CBDC ban faces legislative hurdles or delays, the narrative collapses instantly. Chainlink's value proposition is tightly coupled with regulatory clarity. If the political winds shift, the speculative premium embedded in that $8.45 price evaporates. Furthermore, the core scientific disappointment raises the cost of doing business across the entire industry. Higher energy costs and operational inefficiencies mean that even Chainlink's partners are facing margin compression. It's not a safe haven, it's a liability chain.
Finally, let's discuss Solana. Solana is up 1.03% to $76.69, with a high of $77.03 and a low of $75.56. Grid, is this leadership sustainable?
Solana is acting as the leading indicator for risk-on sentiment. The move to $76.69 is holding above the $75.56 intraday low, establishing a local floor. Historically, when Solana expands its green candles while Bitcoin consolidates, it signals that altcoin liquidity is waking up. The technical structure is intact, with support tightening around 75.50. If Bitcoin holds the $64,000 zone, Solana is poised to test the $78 region as capital rotates from Bitcoin dominance to altcoin beta.
The flow data shows consistent inflows into Solana-based decentralized finance protocols, particularly in lending and staking. This mirrors the broader trend of yield-seeking behavior. Investors are locking up capital in Solana to earn yields, reducing circulating supply. This supply shock mechanism supports the price at $76.69 despite the broader market fear. It's a self-reinforcing loop. Higher stakes lead to tighter liquidity, which supports price appreciation.
So to synthesize, Grid sees Solana as a technical leader, CIPHER sees it as a supply shock vehicle, and Pulse recognizes it as the retail gateway for risk-on trades. The convergence of these factors makes Solana the strongest barometer for whether this extreme fear environment is actually a bottom. If Solana breaks $78 on rising volume, it validates AVAX's thesis that the market is rotating into high-growth assets rather than fleeing entirely.
Here is your summary for the pre-market session. First, Bitcoin is holding at $64,643 in a liquidity vacuum, with futures demand at 2024 lows, creating a fragile but stable equilibrium. Second, we are witnessing a sharp structural divergence. Retail fear is at 14, yet capital is rotating into utility-driven assets like Avalanche and Chainlink, fueled by institutional tokenization news. Third, geopolitical risks, including the 700% spike in Iranian outflows, remain a significant threat to stability, demanding caution despite the green candles. Tomorrow, watch the PayPay IPO filing and whether Bitcoin can maintain the $64,000 support level without leveraged backing. Thank you for listening to the ShadowQuant Crypto Edition. This is AI-generated content for informational purposes only, not financial advice. That wraps up this edition of ShadowQuant Crypto Edition. Stay tuned for the London session, where we will see how these calls play out. Until then, trade safe.